Good morning, Bitcoiners. Hello, and welcome back to another edition of your Bitcoin Economic Calendar. I'm Mauricio Di Bartolomeo, co-founder of Ledin, and as with every Tuesday, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Tuesday, November the 16th, and we have an action-packed week as always. In today's issue, we're going to talk about a new Bitcoin ETF, which is scheduled to start trading today. We're going to break down how that could impact markets. Separately, we're going to talk about the Fed, who is holding a press conference to talk about stablecoins this week. We're going to look at what we can expect and how that could impact markets. And last but certainly not least, we're going to break down a $1 trillion plus stimulus package, another one that's coming into the US economy this week, and how that could impact markets in the weeks and months to come. So grab your coffees, everybody. It's going to be a great one. And before we get going with today's show, we wanted to remind everybody that during the month of November, we have our one Bitcoin giveaway. So remember, you can win one Bitcoin by referring your friends and family to Ledin throughout the month of November. Conditions apply. You can check out our blog for details and our website for the full details of the campaign and the promotion. So starting as we usually do with Bitcoin, we see that last week, Bitcoin soared to yet a new all-time high of 69,000, and it settled on Sunday to essentially close the week at 65,509 cents, up 3.49% for last week. So last week's close did represent Bitcoin's highest weekly close ever, and right now we see that it's under pressure so far this week, currently trading at around $60,800. Continuing to consolidate within $10,000 of that all-time high that was reached last week. Looking at some of what's happening under the hood, last week we covered that there was a lot of anticipation over the VanEck spot Bitcoin application and what that could mean for other funds like the GBTC. So to break that down, the SEC had until the end of day Friday last week, November the 12th, to reject VanEck's spot Bitcoin application. The rejection letter was published at 11 a.m. on Friday, with only hours to go until the deadline. And here is the headline that you have from Business Insider of that rejection letter or the notice itself. The rejection letter from the SEC referenced that spot Bitcoin markets can still be manipulated, end quote. Shares of the GBTC fund or shares in the GBTC fund had been rallying on the expectation that VanEck's application could be approved and that this could have positive implications for GBTC following suit. Now, as we can see here, leading up until last week, the premium or the discount rather on GBTC units relative to the net asset value of the Bitcoin that it holds, that discount had actually dropped to really within single digits, basically negative 8.9%. Once the rejection letter was published, we saw that this discount essentially more than doubled and it went back to negative 18%, currently trading at significant double digits, negative down 14.27% relative to its asset value. So as we said, there was a lot of expectation. There was some, investors were getting excited that this could potentially mean the GBTC could turn into a premium, into an ETF, therefore putting a lot of pressure upwards on this net asset value to go to par. This wasn't the case, so it sold off once the rejection letter came through. Now, VanEck's spot Bitcoin ETF rejection did not deter VanEck's futures Bitcoin ETF application. This application still went ahead, and this fund, VanEck's Bitcoin futures ETF, is actually scheduled to start trading today. But on the topic of ETFs, let's speak or check in a little bit on the existing futures ETFs that are currently trading. And this was a tweet that was posted by Bloomberg's Eric Balchunas last week, Bloomberg's ETF analyst, Eric Balchunas. And he stated that both BITO, the ProShares ETF, and BTF, the Valkyrie ETF, the ones that are currently listed, both of those Bitcoin futures ETFs had their biggest volumes in about 2 weeks in last Wednesday's trading session. And this is the graph that references that trade volume. This one in particular is for the ProShares Bitcoin Futures ETF, BITO. And that ETF had almost $400 million of traded volume for that day, with around 25% turnover in one day, meaning that 25% turnover, meaning that a different fund is holding the shares essentially between the start of the day and the end of the day, which signals that this ETF is being used as a trading tool for institutions, a relatively short-term trading tool since it's turning over 25% in one day. Now, this is consistent with the ideal use case of Bitcoin futures ETFs. As we have discussed here at length, futures-based ETFs are good for following or tracking short-term directional price moves, but they are inferior to spot ETFs or owning the asset outright if you want to have long-term exposure. And that has to do a lot with the contango bleed that we talked about, the fact that the futures premiums tend to trade at a premium value to the spot price of that Bitcoin. So going into the futures markets and how the ETFs continue to impact this, the continued demand for these futures ETFs has created a surge in demand for CME Bitcoin futures contracts. And this we can see in the implied yields for these futures contracts. Just put them up right here. And so as you can see here, let's just keep the CME only. We can see that these implied premiums on a rolling 3-month basis remain very, very elevated. Currently, it is trading at around 7.5% implied premium. This is much higher, almost double where this was in September. As we can see here in September, this implied premium was trading just near, the 2 to 3% range. So again, just a considerable increase due to the demand in these futures contracts that the ETF needs to hold. So again, just staying on top of these, on the space and what can be coming next, the next big catalyst for the ETF world should be the SEC's decision on Grayscale's GBTC application to turn that into a spot Bitcoin ETF. This rejection should come on or before December 24th. So it should be a very interesting holiday season in the Bitcoin ETF world. Moving over to the S&P 500, we see that last week the S&P posted its first week of losses in over 5 weeks. And so the index, the S&P 500 finished down just 13 base points at 4,688 points. Both the NASDAQ and the S&P, both the NASDAQ and the Dow Jones also finished lower. So NASDAQ, as we see here, finished lower by 97 basis points, almost 1% last week. And we saw that the Dow Jones similarly finished down 63 basis points again last week. The headwinds on equity markets came largely from October's inflation reading in the US, which came at 6.2% annualized, and that represented the biggest month-over-month increase in more than 30 years. So as you can see, this is the headline that CNBC posted around this. US bonds sold off on the news, pushing the implied interest rates materially higher, implied interest rates for these bonds. The rate on the 10-year year, and let's just pop these charts so that you can see what we're talking about. This is the surge on the yield on the 10-year note. So this surged 9% last week. That interest rate is sitting at about 1.58% for a 10-year bond in the US. If we look at the implied yield on the 30-year note, that also rose 3.66%, both of which are showing continuations to the upside this morning. So again, the yield on the 30-year note is currently at 1.99%. So again, even though the interest rates on US Treasury bonds have risen dramatically, they are still materially below the inflation mark. If we assume that October numbers for inflation can remain sticky, this means that the real return on a US 10-year bond in the coming year is negative 4.62%. And we get there simply by taking the inflation and subtracting the return of that bond. So 6.2 minus 1.58 is negative, 1.58 minus 6.2 is negative 4.62%. So that is essentially what bond investors are getting in return, considering what interest they're getting and the inflation that is currently out in the markets. Now, in the face of this surging inflation, the US government is scheduled to add yet another $1.2 trillion worth of stimulus through an infrastructure bill today. And that is the article that you have on your screen. In fact, just recently, actually minutes ago, it seems like President Biden has signed the bipartisan infrastructure bill into law. Now, just to speak a little bit about what this can lead to, being able to borrow below the rate of inflation leads to one thing and one thing only: wealth concentration. The wealthy are typically well-versed in market structure, and they use inflation to their advantage. They typically own many assets, which not only appreciate, but allow you to borrow from them to purchase even more assets. We wanted to share this graph that was actually shared by Tracy Alloway from Bloomberg throughout the week. And this highlights how the top 1% of the US population earns over 20% of the entire US income share. The top 10% of the entire US population make up more than 50% of the entire income distribution in the United States. And this tweet was basically the subheading, or the commentary on this tweet was saying a return to the Gilded Age. Rising rates and a rising dollar put structural pressure on equity markets. Even though the infrastructure bill may work to put a bid on the markets for now, it runs the risk of overheating inflation even more by putting more monetary or units of money into the system. The US government is doing everything it can to control the inflation narrative, and we get to hear from many members of the Fed this week. More on that in our What's Ahead section later today. Moving over to our analysis of gold, we see that gold soared last week, finishing higher by 2.64% at $1,864 per ounce. Again, 2.64% rally on gold for the week is actually one of their biggest weekly gains in so far this year. A soaring 6.2% inflation reading in the US was able to compensate for a 1% rise in the US dollar index. Here we see that the US dollar index is just surging. It surged 1% last week, up another 63 basis points this morning. With oil prices, just again checking in on oil as well, we see that oil prices are still trading north of $80 per barrel, and gasoline prices in the US are soaring. All signs seem to point to more inflation in the foreseeable future. This has prompted some market observers to call for a good few months ahead for gold. And that is one of those headlines is the one you have from CNBC last week, stating that gold is set to rally in the coming months, according to two experts. Inflation is beneficial for gold, and as we know, gold is inversely correlated to the real return of US bonds. So again, inflation is just one part of this equation. A lot will depend on what happens to the interest rates of US Treasury bonds. However, judging by the levels of debt that the US government and pretty much everyone else is taking on, it is unlikely that the Fed can let rates go too high without creating a structural risk to the economy. So this might be what some of these experts are seeing that could lead to a few months ahead for gold. Moving over to our DeFi analysis, it was an action-packed week in the DeFi world last week. The DeFi index finished last week down 4.22%, and it's actually significantly down so far this week, down 8.45% for the week as of this morning's trading session. And looking at Ethereum quickly, we see that price action was slightly different, as it did reach a fresh new all-time high last week and also closed at its highest ever weekly candle, essentially highest weekly close ever. And it was up by just 28 basis points and closed the week at 4,630. We see it come under pressure again this morning, along with pretty much all the other crypto assets, down 6.84% so far this week based on current trading prices right now. Now, we wanted to spend a minute on this section to answer some questions that were essentially highlighted by our readers as content they wanted us to cover. And we wanted to spend a minute here to cover the latest news on how the SEC is looking at stablecoins and what the implications might be. The article you have on your screen right now is a recent one from Roll Call, and it highlights that the SEC's Hester Pierce, who is also known as Crypto Mom, a very in the eyes of many industry participants, she's a very crypto-friendly or crypto-forward regulator or official. And she says that she sees room to regulate stablecoins through a bank lens. Now, to break down a little bit what they could be making reference to, the SEC's mandate is to protect consumers. As such, it probably wants to ensure that it understands that stablecoins reserves are indeed dollars and also safe at all times. While this regulation might sound burdensome, reputable stablecoin operators like Circle, who operates USDC, have been engaging with regulators to ensure that the regulators understand the business and how to regulate these types of companies appropriately. Interestingly, we'll get to hear from the Fed on stablecoins this Wednesday. The Cleveland Fed President Loretta Mester and Fed Governor Chris Waller will speak at 11:20 a.m. Eastern Standard Time on Wednesday, and more details around that in our What's Ahead section later today. Stablecoin operators will also have, or should also have, the financial means to comply with bank regulations. Given they have had quite successful fundraising and they seem to have great support and backing from world-class institutions and investors. Now, the outcome of this could be that there will be a segmentation of US regulated stablecoins versus non-regulated stablecoins, which ultimately will provide more options and more protection in some cases to consumers. Moving on to other parts of the DeFi world, we also saw, just checking in on the NFT craze for a second, the NFT mania continues to heat up, with none other than Jimmy Fallon announcing that he purchased a Bored Ape NFT last week. While this trend shows no signs of stopping on the NFT side, other trends in DeFi are not as positive. Following up on Cream Finance's $130 million hack from last week, the protocol announced that it had decided to print new tokens to compensate for the losses of the ones that were involved. And so when this decision was announced, as you can see, the value of these tokens absolutely plunged when the news came out. Price action that we're seeing right now shows that the DeFi index, and just again to highlight this, we see that the DeFi index is quite away from its all-time highs. And if we look at some of the specific components like Compound, like the Comp token, it is quite materially away from its all-time highs. Keep in mind that seemingly every other asset class is at or near all-time highs. This could be a sign that the hotball of money has chosen to move into other tokens or asset classes for the time being. Moving over to our Bitcoin mining difficulty commentary, we see that last week Bitcoin received a historic upgrade by activating Taproot. The upgrade will introduce new functionality and improve privacy for Bitcoin transactions. We'll be diving deeper into the specifics in future issues, but at a high level, Taproot enables Schnorr signatures, which simply put can make multi-signature Bitcoin transactions indistinguishable from regular transactions. Currently, when you spend out of your wallet, the blockchain shows whether it comes from a multi-sig or a single key address. So this is a big upgrade for privacy. Checking in on difficulty, we see that the last adjustment was this last Sunday, brought difficulty higher by 4.94% to 23 terahashes, 22.97. We are now within inches of our 25 terahash all-time high, and we are almost fully back from the China slump. So again, very positive. And the mempool continues to be clear, and transaction times and costs remain optimal. Now, as always, we leave you with what's ahead for the week. And we have some exciting stuff to announce or to share with you this week. Ledin will be at La BitConf this week in El Salvador. So come visit us at our booth. We'll also be participating on a panel on Thursday. Check out the event page for more details and reach out to us on social media if you're there and want to connect. Onwards to what is ahead in the macro world and for Bitcoin. So as we mentioned, inflation is surging and the powers that be are feeling the heat. Biden has been openly addressing soaring gasoline prices, and the Fed will be out in the media, likely getting grilled on inflation and what it plans to do all throughout this week. So we'll break that down shortly, but there's a lot of Fed activity. Speaking on that specific point, There's a very interesting article that came out of Wall Street Journal over the week that said that, the Fed essentially is talking about the Fed's credibility and the fact that the Fed is potentially running out of excuses. The Fed has been saying that inflation should subside for longer than many can remember. And the term transitory has become a trigger word for many. Expect the Fed to bang the same drum in the week ahead as it speaks to the media and the American people. There is more paper, but there is less money. And this is a commentary that we wanted to share from this graph that was shared by Noah Smith last week. And this highlights that this is just a very interesting data set for the United States that highlights that the contribution of international immigration to the US population growth seems to have reversed its trend over the past 6 years. As we can see here, it looks like there's basically a structural shortfall of about 2.1 million people that were expected to come into the US through immigration. This is not great for the US economy, and it highlights just how much of the recent growth in GDP has been financial growth versus organic population growth. As always, we wrap up with a summary of the upcoming economic data and earnings reports that we can expect this week. Just realized this is the structural graph that I was intending to show based on the basically that shows the reversal of the trend in immigration contribution into the U.S. Population. And I will also just share the one that the Fed is running out of excuses, which was supposed to be presented just a minute ago. The one in the Wall Street Journal speaking about the Fed's credibility. So now moving on to the actual weekly breakdown and the summary of the Fed activity, because we're going to have quite a bit of that this week. Today, Tuesday, 8:30 a.m., we get U.S. retail sales. There are high expectations here for a 1.5% month-over-month increase. If the number comes in below, it may put pressure on equity markets. The number actually recently came out and it was just above expectations. So again, no big concerns here so far, as the majority of analysts were expecting a big increase. So it's pretty much in line with what was expected. Earlier this morning, the VanEck Bitcoin Futures ETF should start trading, or later today. In fact, they don't typically start trading right at 9:30 a.m., but it should start trading at some point in the day today. So it will be interesting to see how the new VanEck ETF starts affecting the flows into the other existing listed ETFs. 2:30 p.m. today, San Francisco Fed President Mary Daly speaks. Tomorrow, Wednesday, at 9:10 a.m. Eastern, New York Fed President John Williams speaks at the Treasury Market Conference. At 11 a.m. Eastern tomorrow, Fed Governor Michelle Baumann speaks. And at 11:20 Eastern Standard Time tomorrow, this is a very important one for the crypto industry, Fed President Loretta Mester and Governor Waller will be holding a press conference just to address stablecoins. The next conference on the same Wednesday is at 12:40 p.m. Eastern. San Francisco Fed President Mary Daly, yet again. And at 4 p.m. Eastern, Chicago Fed President Charles Evans speaks. As you will see, there is a lot of Fed activity this week. 8 a.m. Eastern on Thursday, Atlanta Fed President Raphael Bostic speaks. 8:30 a.m. Eastern, we get initial and continuing jobless claims in the U.S. Expectation here is for a gradual reduction of new unemployment claims. While no single month move should derail markets, the bigger risk here is for a surprise to the upside, so more new claims than expected, as this could derail the current recovery narrative. 2 p.m. Eastern tomorrow, Chicago Fed President Charles Evans speaks. 3:30 p.m. Eastern tomorrow, San Francisco Fed President Mary Daly speaks yet again. Friday, we wrap up with Fed Governor Christopher Waller speaking again. He's the one that will be addressing stablecoins on Wednesday. And at 12:15 on Friday, we get Fed Chair Richard Clarida speaking again. So a lot of Fed activity here. Expect a lot of conversations around inflation and what the Fed expects to do. It's going to be a big one. We'll keep you posted on our social media and right here through Huddle with Lennon. If you have any comments, questions, or feedback, please drop it in the comment section. We'll look to tackle your comments or questions in the next issue. If you like the show, if you learned something today or enjoyed it, I welcome you to like it, subscribe it, share it with your friends. If you don't have a Ledden account yet, check out ledden.io and learn how you can start earning up to 9.5% on your USDC and up to 6.25% on your first Bitcoin. We also have the best rates for Bitcoin-backed loans if you need liquidity and don't want to sell your stack. Thank you, everybody. Have a wonderful week and see you in El Salvador.